Good morning, everybody. Really appreciate your time, taking the time out to listen to the conversation that we're going to have today. The theme is all around sort of, are you doing more customer due diligence than you need to? It's quite a provocative question, and are you doing too much versus are you doing too little? And I'll be moderating the conversation today to sort of introduce you to the panel and sort of take you through some of the themes that we wanted to talk about. Now, we all know that regulators, including the FCA and policymakers such as the Financial Action Task Force, are stepping up the requirements on all regulated financial and professional services firms to strengthen the initial risk assessment process and improve the ongoing monitoring of customer risk. But it all starts with a very robust initial risk assessment process at the start of a true risk-based approach. But these risk-based approaches are being seen to be more difficult in practice than it sounds. And many firms, we understand, are struggling with getting the right level of due diligence needed to match the assessed level of potential financial crime risk. And sometimes this leads to companies not doing enough, and frequently it leads to companies doing too much. So the idea is how do we get the balance right? We're also going to look at how the best-in-class businesses are getting ahead of the curve using the latest technology and open source intelligence sources and data analytics. We all know that compliance budgets are also under pressure, and many firms are looking to reduce their costs by turning to technology and redesigning their AML controls. But they need to do that without sacrificing their effectiveness. In fact, they need to be more effective. We need to get this balance right between costs and effectiveness. So with that in mind, I'm delighted to be joined by our illustrious panel. We will discuss these themes, but let me start by asking each of them to give us a short introduction of themselves and their sector experience. And maybe Christine, we will start with you.
Thank you very much. Good morning, everyone. So my name is Christine Drabo, and acting as the UK Head of Compliance and MLRO for Transwap Group's technologies. My experience within compliance and anti-financial crime goes back to about 8 years now. And my expertise really sits around e-payments, or what we call payments and electronic money industry. I've mainly focused on working within fintechs, from startups to bigger entities that are actually listing on the New York Stock Exchange. And I'm very pleased to be sharing with you my experience and expertise on the subject. Thank you.
Over to you, Ken.
Good morning, everybody. My name is Ken Irving. I work with Protiviti, a consultancy. I work in the financial crime compliance space there. I've been there for 10 years. The previous 10 years, I was responsible for AML in the first line at a global funds group. And I think one of the ideas of this podcast came about from a conversation that Ian, Mike, and I had. Because in my experience, as I go around a lot of clients, seeing a lot of different KYC models, AML models, then as the AML models mature at certain places, it looks to us as if too much is being done in certain areas, especially, I'll be blunt, areas where it's quite easy to do KYC or CDD, and maybe less where it's more difficult and probably more necessary because of risk. So looking forward to a lively discussion today.
Thanks, Ken. Brian?
Hi, good morning, everyone. My name's Brian Swainson. I'm currently the Deputy MLRO at Fidelity. I've been here just under 6 years. I've just ticked over the 30-year mark in financial services earlier this year, predominantly in the first line sort of operational space, slowly moving from not very much to do with sort of financial crime controls to it being a very strong focus for probably most of the last 15 years, and then making it sort of exclusive in the last sort of 7 or 8. And I've worked predominantly in the asset management space, back office administration for both asset managers doing the activity in-house and also transfer agencies providing it as a as a third-party administration service. So kind of seeing it from both sides, sort of provider and supplier, as well as poacher turned gamekeeper, moving from first to second line.
Thanks, Brian. And finally, Sam.
Hi, I'm Sam, so I'm Head of Research and Development at Neotas. So started off working mostly in open source intelligence, and then recently been working on building up technology and processes to speed up EDD and CDD research to make the processes more efficient and kind of save time and make sure people are doing the right things and doing the appropriate research.
So thanks, Sam, and we'll look forward to some of the comments later around some of the tools and techniques that you're currently using. I guess we'd start off with sort of asking the question and asking the panel, maybe to start off with a reminder of what regulations require us to do CDD. You know, where does it all start and what are the various levels of checks that are required? Basically just provide some context to some of the questions that we'll sort of put up later. And actually, one of the things I should remind everybody of is that there is a Q&A section in the webinar here. So if you've got any questions, please feel free to put them into the text box, and we'll look to see where we can answer them towards the end of the webinar, if time allows. So with that in mind, sort of, what factors do we need to take into account when doing the risk assessment? You know, and has it in fact led to a situation where in some cases we are doing too much DDD and not enough in others? And maybe I'll start off with Brian on that one.
Yeah, sure, happy to. So I'm sure most people on the call will be familiar with the concept of low, medium, and high risk, which traditionally, most people will align with simplified, standard, and enhanced levels of due diligence. And the guidance that's out there, so the JMLSG, which I know we'll talk about a little bit later, but the JMLSG provides a great interpretation of that in terms of the factors you need to consider: the customer risk, including any political exposure, for example, the country risk, not just where the customer is based, but where they're generating their monies, the type of product you're offering, how suitable or unsuitable it is for money laundering. So pensions typically seen as very unsuitable and yet still could be used, whereas other more free-flowing activities like a bank account clearly much more useful. And then the channel, most product providers are delivering services on a non-face-to-face basis. So that introduces additional challenges around both impersonation as well as fraud. So they're kind of the main factors. But again, every firm's going to have their own appetite to this. I mean, each firm needs to have decided based on who their typical clients are and the products they offer, how to perform that risk rating. And then you get the nuances. So even though some firms, potentially a lot of people on this call will have firms that offer the same rating process, but you may still have different outcomes. So a common variation I've seen is in the case of individual customers, your good old Mrs. Miggins, who's putting her, £500 into an ISA. Is she a medium risk client because she's non-face-to-face and the product might allow third-party payments, or is she low risk because it's only £500 in an ISA? And actually, in both cases, the firms are probably applying exactly the same level of due diligence, and the risk rating is not quite so important. So it's going to vary very much, and firms and people need to understand that sort of variation. And clearly, if you are a firm or a product that offers very vanilla products, retail products, you may take a view that anyone outside of your vanilla retail individual is high risk because you just don't have enough exposure to it. It's unusual to you, even if it's not high risk in and of itself. So again, that will come down to appetite. So again, it's going to vary, but in terms of the process itself, I think the requirements are well documented, but with huge opportunity for firms to take their own approach.
Sorry. Thanks, Brian. Ken, would you like to add something to that?
Yes, sir. I mean, I think for me, the JMLSG there's a great quote there from part 1 at 18, And what the GML-SG says around risk, it says it's not intended that the guidance, GML-SG guidance, be applied unthinkingly as a checklist of steps to take. Firms should encourage their staff to think risk as they carry out their duties within the legal and regulatory framework governing AML and CTF. The FCA has made it clear its expectation that FCA-regulated firms address the management of risk in a thoughtful and considered way, and establish and maintain systems and procedures that are appropriate, which to me means do enough, and don't satisfy the guidance and requirements, because we're not saying fall below those. So procedures that are appropriate, and that was do enough, and proportionate. In other words, what that's saying to me is don't do too much. Only do enough to satisfy the risk element and as defined in the regulations. And this guidance assists firms to do that, and I think that's so important. And what I do with my staff is I have them print that quote off and keep it by their desks when they're working on a for example, a remediation project. Because I want them thinking about risk. I don't want them not thinking about risk. I don't want them just checklisting, because then they will challenge and say, why are we doing this? Why is that data point necessary? Is it a regulatory minimum requirement, or are we just getting it because we've always got it? And I think that think of the risk that you're mitigating by getting data points, validating data points. I think that's so important. And again, I agree with everything that Brian has said around how different firms look at the same things sometimes quite differently. An example I had recently was in fact around an ISA, where an ISA was being sold by an insurance company, and that to them was medium risk. And in other words, it was deemed to be higher risk than pension, so they put it as medium. Where I think at most banks, an ISA would generally be low risk, and so it's comparatively high risk for them, medium risk, but in reality, in absolute terms, it's actually low risk. So I think that comparative situations is really important. Ian.
Thanks, Ken. And Christine, when we sort of think about these things, sort of what factors do we need to take into account when we're doing the risk assessment? Obviously, your experience is somewhat different from everybody else's in terms of coming from that e-payment sector. So can you think about sort of a situation where in some cases, again, we're sort of doing too much versus maybe not enough?
I think it's very key for us to understand the type of customer that we're actually creating a business relationship with. Because with the type of customer that, if the type of customer is not defined at the beginning, then it's going to be a little bit hard for you to apply the risk-based customer due diligence that you need to apply. That is also factoring in other risk factors such as the jurisdiction, the type of product that has been already covered. But if you can understand the customer that they are bringing in and sort of relate to the risk exposures that you have, then you'll be in a better position to actually have a better risk-based approach in terms of the risks that you face and prioritizing them and understanding the type of due diligence that you need to perform on that particular customer. So that is sort of the approach that I see within payments, especially since it's more digital and non-face-to-face. Yeah.
Yeah, thanks for that. So Ken, when you spoke, you mentioned about the GML-SG and what they say. I mean, I guess you've got experience both as a practitioner and now as a consultant. Do you want to sort of pick up on a couple of the things in terms of what you originally saw or in your previous life versus sort of what you see now, and maybe talk about sort of how those processes and procedures sort of begin to get misaligned with the AML control frameworks, etc.
No, absolutely. I think a classic example is probably around PEPs, where I think we've seen that area evolve, and it's been helpful, the guidance the FCA gave in 2017. The FCA gave in 2017, because PEPs have really evolved from being once a PEP, always a PEP. to now where we're seeing a situation where the FCA guidance allows you within the high risk and EDD element that PEPs automatically bring, but you can low, medium or high risk within that high risk category. So for example, if a PEP is domestic, we're talking about low risk products. They're just a member of parliament versus a government minister, whatever, then we see a situation where a proper risk-based assessment can be done on the PEP and not just an automatic trigger to every year EDD and do loads of work. So I think that's a classic example of how PEPs have moved. The problem is that a lot of organizations haven't moved. They may not quite be doing once a PEP, always a PEP, because of course you're allowed in certain circumstances to de-PEP them, if you will, after a year out of office. But I think a lot of organizations are still doing too much. They're doing annual assessments where, again, if one applies the FCA guidance appropriately within the risk that customer brings, you may not have to do a review every year of them. So I think PEPs is a classic example where some organizations are a bit stuck in time. They're doing what they're doing because, well, that's what we've always done with PEPs, whereas other organizations are applying what the FCA actually wants you to do, which is take a much more risk-based, nuance-based approach to PEPs, depending on the specific circumstances and risks they bring. Yeah.
Great. Thanks for that. And Christine, do you want to sort of add in something around sort of, what leading firms doing versus the average institutions? What do you, I guess you've been involved in sort of implementing some of these programs. So actually, what does good look like?
I think good looks like actually having I would call it risk profiling. So you should have a policy in place that sort of reflects the risk of the customer, and you're then able to do the screening. As you can see, they've touched on PEPs as an example, which is very good. Your policy should also include your sanction screening. Not everybody is going to be, if you're a PEP, it's not a bad customer, but it's how you actually understand that customer. Then it comes down to doing your screening after you've risk profiled them, and then knowing what particular documents that you will need to collect from that person, and then implementing your ongoing monitoring. So if you break it down, you start with the risk-based approach before you define it is your risk factors. So we're looking at the products, you're looking at the type of customer, you're looking at the jurisdiction, understanding the services that they are going to need. Once you risk profile that and give them a good risk rating according to your policy that is in place, then you should be able to really understand the types of documents that you're going to collect that are reflective for you to be satisfied that that person sits where you've rated them, for example, if they're high risk and they're PEP, and then knowing the mitigations that you're going to follow up with in terms of the ongoing monitoring and ensuring that, if they're going to stay high and it doesn't change, if it changes, then you're able to come back and evaluate and actually change the risk profile, say to medium or to low risk. So that is sort of what I would call good practice in terms of that. But it starts with the compliance officer being able to create that risk policy for you in-house. Yeah.
I think, Ian, if I can just pick up on that, because I completely agree with Christine. I think that one thing that sometimes does not happen, though, is looking at the outcome of the risk rating across the entire population. So for example, I have been at a client and 50% of their revenues were from customers who they deemed at a high risk of committing a financial crime. Now that's awfully high, and some drug dealers would probably wince at that risk profile for their customers. And I think looking, standing back from the results of a risk assessment across the entire population, saying, does that actually make sense? Is this a business that's tenable to be dealing with? Again, 50% of our revenues is coming from customers who apparently are probable to commit a financial crime, if that's how we interpret high risk.
But Ken, do you solve that? I mean, do you think people should be doing sort of audits of that risk-based approach? I mean, actually, you know, where the risk comes from, and to some degree, is those high-risk accounts. Well, actually, if you've deemed them high risk, you're doing due diligence. But actually, if you've deemed them low risk or medium risk, and that, you know, they're the ones that can come back and bite you. So actually, sort of doing the review of actually, you know, where your issues are coming from and whether they were deemed as low, medium, and high risk to start off with, you know, is.
Yeah, totally. I mean, I think that the point is that gives you the opportunity to revisit your risk rating methodology to make sure it actually makes sense. In the case of this customer, a product was automatically triggering high risk. And what that did was trigger a review to make sure that product really was automatically triggering high risk, and there were compensating controls and all the rest of it which could be pointed to. In fact, they're able to reduce that. So genuinely, it wasn't a high risk situation. It just got deemed it. And I guess I'm just, you know, what I'm advocating is really just a common sense approach to it. Make sure that the numerical thing reflects the reality of risk. Again, back to that JMLSG quote, think risk. And I just think that's so true. Let's keep thinking risk. Let's move away from tick box exercises and make sure that we're doing what we need to do. Because the reality is, in you know, most financial institutions now have been at this AML stuff for quite a while. You know, the overall AML control environment is better than it was, you know, 5 years ago, certainly 10 years ago, absolutely 20 years ago. So you need to be able to flex what you're doing, again, within the guidelines to reflect the fact your overall AML control environment is much better. Transaction monitoring is so much better than it used to be 5 or 10 years ago, for example. And you know, anyway. Ian.
So maybe I'll bring Brian in on this next bit, because obviously, Brian, you were talking about sort of starting life or being in sort of the first line of defence and what have you. You know, but how do you see some of these issues between the first line and the second line? How do they sort of play out? You know, and you know, do we have the right skills within those two sectors?
I mean, it's an interesting question, and I think I've certainly seen, you know, when I first started in the industry was right at its infancy, when you know, way back when an advisor could just wave a magic wand and say, I knew them before 1994 and you don't need to worry about it, or source of funds checks where you just expected the check to come from your, you know, that person's own bank account. And back then it wasn't ISAs, it was PEPs, which confuses everyone now, but where the contribution limits were much lower than they are now. So you had a totally different, obviously inflation's helped, but you have a totally different kind of model. And back then it was very much more basic in terms of its requirements. And it is intriguing. I did this last year. I was trying to find a sort of track a change through the JMLSG, and obviously all of the old versions of the JMLSG are still available on their website, and you can just see the genesis through that process, which I've got to say is much easier to do than try and follow the genesis of the regulations that they were intended to support. But I think, but that's an important point, because when these first line teams first were created, it was part of a process. You know, if you're doing data entry and you're ticking a box, it was much more simplistic. And I think what I've seen over the years is there's greater demands on that first line teams to think, to quote Ken, to think risk, to actually be more holistic in the way you're approaching that case. And that is, you know, I've worked in all the, you know, nearly all of the different areas across a first line function. Almost everything else that you do is very much rules and threshold based. It is very much a process flow that you go from left to right, up and down, and there is always a binary option to do or not do something. Whereas with this, you end up with, it may be different, and that's a different mindset. And one of the things I've seen is that some firms still consider their AML operations team to be, you know, a processing team rather than a financial crime prevention team. And that's a different skill set. It requires, you know, if you're trying to, you know, manage people according to widgets and cycle times and, you know, throughput, if you have a complicated case, you're going to want to take time to look at it properly. Whereas if you're just placing a deal or just performing a change of address function, you know, it takes 8 minutes or whatever that time is every day. So that's a different model, and I think firms definitely have struggled. And as a result, you know, you create there's probably a lack of appreciation for the skills you need in that function. Now, I would say that because it's a job I've done before, but I think that probably will resonate with other people here, because you're expected to think like a second line person, but you're not necessarily, you know, rewarded in the same way. And I don't just mean financially, although clearly that's one factor, but I mean in terms of, you know, being given the latitude and decision making and the authority to make certain decisions and use your judgment. And I think for me, the best firms will have a really kind of clear and linear growth path that takes them up to the top end of the first line team, and probably has an overlap where, if you like, the best people in your first line team are better than your most junior people in your compliance team. Whereas again, other firms will see it as compliance is above the first line operational team. Whereas actually for me, you need that middle overground, or that middle ground, the line 1.5, some people have referred to it, or some firms have referred to it. The problem you have is people want to jump from first line to second line. So it's very hard to cultivate that population of people who genuinely see a career in that middle ground. And I think the more that we do that as an industry, the better the process will be, because I've also seen challenges where you have first line people who don't necessarily understand what the regulations are trying to achieve, and you have second line people who don't understand the systems that the poor first line people have to use, which are sometimes not optimized, shall we say. So you need someone, that middle group, that understands both. So again, my background allows me to kind of have some insight into both sides of that piece, but there aren't many people that have done that in my experience. So people that understand the middle piece, fundamental, because you can actually act as translator to both sides.
Sure. Okay, thanks for that. Well, sorry,
I'll
Christine.
I'll just add that from a fintech perspective, because, you know, normally within fintechs we don't have the pleasure of having too many teams, so it sort of has to balance out. But I think you've touched on something that is very key in terms of first line and second line. You know, when we come to look at the experience, the expertise that sits with either levels, I think it's very fundamental for a second line to understand, and we go back looking at risk management in this case, and understanding the 3 lines of defense. You could sit at second level, whereby you're actually supposed to create and have oversight, but we need to get the first line to understand that actually they're the risk owners, and they're sort of the ones that actually act as people who are there to safeguard the company in terms of AML. And the responsibility also sits with the second line. If I have people in the first line that cannot actually own the risk and understand it, I need to provide the training such that they understand, for example, the risk factors and how the risk exposure would come around. Jumping from first line to second line, I think, is too quick. But if you've been in a company and you really understand their products and services, and you understand how risk works, then it's easy for you to probably just step the hurdle and jump. But the balance between the two, I think, has to be within the risk management and understanding those risks, 3 lines of defense, and everybody understanding what they're supposed to do, and sticking to that, around that, to be able to support each other. Yeah.
If I can just add a couple of thoughts, Ian, really building on what both Brian and Christine have said. One often finds that, first of all, very senior executives running first line KYC operations have never themselves done a KYC file. That's one of the first red flags that I look for, because if you've never actually done a file, that includes second line people as well, not just first line people. I think that's quite disturbing, because you need to have done a few files within your organization, within the systems. Back to, as Brian mentioned, they may be suboptimal, for example, those systems, and how long that takes. So you tend to find there's a general brain drain, if that's a term that's still used, from the first line into the second line. And I think when the risk methodology, the risk framework, the how much KYC are we doing, can it drift into too much, is often a function of the fact there's not a healthy interaction between first and second lines to discuss not just individual cases, but procedures, policies and procedures as well. Because you tend to find, as a sweeping generalization, the second line is more risk averse than the first line. And the second line doesn't have to face all of the wrath that the first line has to face in terms of the front office onboarding clients, and indeed clients that are upset because of information they've been asked to do and why am I being asked for that. So I think a healthy interaction between first and second line. First line owns the risk after all. I think is so key to making sure that not too much KYC CDD is done. Ian.
Sure. Well, I guess this is a good point to bring in Sam, because I guess let's talk a little bit about the technology that's out there. So what's out there that can actually help people? I guess, we understand that, the two key aspects of a successful CDD program, is a combination of, quality data and good technology. So Sam, do you want to sort of talk a little bit about sort of, what new technologies are out there, what data sources are available, versus sort of what people are currently doing?
Yeah, sure. I think there's been a few things that you sort of mentioned in this already, which is sort of suboptimality of systems that are being used by KYC analysts. It's causing kind of frustrations and inefficiencies. And then also a demand on people to think risk and not just tick boxes, kind of have an adaptive methodology to the way that they're working that kind of can change to the most efficient route in each case. And then also passing information between different people within the process. So from requesting the information to kind of the first line and second line, passing information through that, how do you do that in an efficient way? And I think one of the key things is having some sort of like a technology that brings all of those things into a single place. So kind of bringing in adaptive methodologies, so technology that can help guide KYC analysts in terms of if certain instances are happening, then what's the next step to be done, rather than just following a kind of standardized kind of tick box, is quite important. But then also having anyone else who looks at this case understand what has been done in that case already, I think is also quite important. And I think when you start to move from the kind of low risk into the medium risk and high risk, then it's about kind of not just relying on those kind of traditional data sources. I think they have a purpose, but they don't always show the full picture, especially in terms of when you're starting to look at kind of networks. You spoke a little bit about politically exposed people, sanctioned people. When you start to look at those networks, I think there can sometimes be an over-reliance on traditional data sources picking up those networks, whereas actually a lot of those networks can be found in sort of more open source intelligence kind of research. So you need technology that can A, find those networks, and then B, overlay those networks onto the more kind of traditional sources, so that you're getting the full picture of an individual or a company and kind of who they're connected to, who they're trading with, so that you understand where the risks are coming from.
I think for me, Ian, just jump in a second on that. I think two areas I would talk about in terms of technology. First of all is false positives. I mean, the generation of false positives, so many places that I meet with, they're in the 90+% false positive area, often as high as 95, 98, some cases 100, believe it or not. That's one area where I think technology needs to help. It's generating these, and so I'm interested to hear any thoughts on that. The second one is pulling information from other parts of the organization which are relevant to AML. And it's often the fact, for example, that prospective clients would much rather give information to the credit department than they would to the AML department. And it's often the same information. And so allowing systems to speak with each other, AML, KYC platform, whatever, to speak to the credit system and pull, as it's relevant within data privacy, whatever, but pull that information so it's shared across the organization. So that's two areas which are really, on the face of it, fairly simple, where technology can help, I think are worth exploring.
Sure. So Sam, do you want to talk a little bit about false positives and sort of the triangulation methods and things that you can use to help eliminate them?
Yeah, I think obviously with the increase of kind of technology with like NLP and artificial intelligence, there's a lot more technology that's becoming available, which can help kind of look through big chunks of data. So like things like search engine results and things that are in unstructured databases, and actually start to understand the connections within those, and also extract identifiers from them, extract risks from them, and summarize the information in a way that basically helps the KYC analysts or the kind of EDD analysts understand the context and understand the matching identifiers that match up with their case, so that they can then start to focus more of their time on the things that are going to be more relevant to them, rather than clicking through these false positives. Actually, the things that have kind of matching identifiers or similar attributes to the thing to the individual or company that they're looking at will come to the top immediately, so that they don't have to spend so much of their time kind of looking through those false positives. The things that they're looking at are instantly a lot more relevant, and also a lot more relevant to the risks that they're trying to kind of identify.
Thanks. And Brian, I think if you're sitting there on the front line. I mean, obviously, the world is changing. The face of financial crime is changing. We're obviously seeing a huge rise in digital cryptocurrencies, etc., digital payment systems, and what have you. How are you seeing that manifest itself from the fraud landscape perspective?
So, I think, I mean, the good and bad thing is that on the one hand, customers are becoming very wary about sharing information with us, which obviously is unfortunate for us and us as an industry. But it also means they're hopefully reluctant to share information with the ne'er-do-wells that are actually going to do something illegal with that information. So I think we have a problem as an industry, because to some extent, I think we're a victim of our own success, in that a lot of the checks that we do and have done in the past are all done, for the most part, invisibly to the customer. And obviously, as we want to beef up those checks and those processes, we probably need richer information from the customer to be able to do that better. So whether that's plugging gaps, whether that's telling us more promptly about address changes, or giving us additional contact information like a mobile phone number, for example, things that allow us to then screen them more effectively. Maybe we'll go and ask them, we've had a middle initial on file for 10 years, maybe we'll go and ask them for the middle name, because that's the difference between a false positive or not, for example. So we need to kind of warm clients up to that possibility, for their protection, for our protection, to prevent financial crime. But of course, firms need to provide a convenient way for customers to do that. And if you're scattergun mailing customers asking for all kinds of information, and they're going to stick it on a letter and post it to us, it's kind of like the old day. Do you remember a long time ago when you used to be able to apply for things on a postcard and you'd write your credit card number? I mean, that seems bonkers now, but that's what people used to do 20 odd years ago. And that's almost the equivalent of sending it. Now, okay, we know in the UK the postal system is pretty secure by sort of global standards, but it's not infallible. And people are very wary. We receive bank statements, for example, to prove ownership of a bank account, so we know it's them paying us, and they'll redact the hell out of every single transaction. So I don't care what you bought in Starbucks, okay? I don't care who your mortgage is with. But again, that's how wary people are. It's if I don't think you need to see it, I'm not going to give it to you. And then, of course, firms then have that problem of, I can't meet my normal standard. But actually, unless I'm suspicious, does it matter? And that's where you then come back to that other point around, geez, who makes the decision? Who decides that that's enough or not? Because otherwise, you're just at an impasse, and you don't want that either. So it's difficult. I think I think firms and the industry want to do more. As Sam said, some of the tools that are available now can be incredibly smart around the use of open sources and AI. But of course, you still need up-to-date customer data in the that we can actually compare you to. If you're John Smith in London, you're going to get false positives a lot more than you are. Perhaps less common names are clearly going to have less of an impact.
Yeah.
So we've certainly seen big spikes when I sort of occasionally follow politics, and it's, oh geez, there's that someone in Wales was appointed as an MP, and it's just absolutely blasted with false positives because it was a very common name. It escapes me, but and that's the problem you have. When that happens, it's very very common. I think our most common screening hit is Muhammad Ali, because globally it's incredibly popular name. So it's very difficult. The good news is the technology is just getting better and better, and the ability to connect to it is also improving. I think probably one other thing I'd say, which is perhaps more of an asset management problem than perhaps some of the others like banking. Again, commercially speaking, it's brilliant because it's long term, but it means that customers typically have had the account for 20 years and done nothing because it's a buy and hold type product. So again, that inactivity, it comes with the characteristics of that product. Whereas a bank or something else, you're using your account 10 times a month minimum, and therefore you could almost be geolocated, but you put in your one payment 20 years ago and haven't been in touch since because it's a 50-year investment. What do you do there? Very difficult.
And maybe Christine, sort of again in the e-payment sector, what are you seeing in terms of trends of fraud, etc.?
So I think within payments or fintech, we have the competition for the customer. So not only am I looking at achieving what I need to collect, but I'm also looking at how that customer is going to actually be able to onboard with me rather than go to another competitor. So technology plays a good part of this. But I think based on and adding to what Brian said, if we come back and we just look at what good data is in the first instance, is to consider the new customer that you're bringing on. So the onus is on actually the compliance officer who is setting up the policy and working, say, for example, with products, working with sales to understand the customer that they're bringing on. Because if I do understand that, then I'm able to set the parameters of the actual good data that I need to collect in the first instance from that particular customer. If I'm to come and look at the existing customer, then, what Ken covered, looking at where you're collecting and aligning with other information that you have within the company is very important, because then it defines what your good data is. I might work with a technology company to understand if this company can actually support us. But if I cannot actually understand the good data that I actually have in-house, the company that is providing me with the technology is not going to be able to, for example, eliminate the false positives. I need to speak the language that they understand, and for me to also understand how the technology is going to support me. So creating the data sets and working with the technology company will be sort of an added value in establishing the type of data that you're going to actually ask for your customer, the type of data that you're going to actually hold, and also bearing in mind if we have to go into data protection and looking at the legal requirements for processing the type of data that you hold. So balancing these and working with the technology company not only just starts with having a tool that is AI, it's actually coming back to define that good data that you're going to put into that technology so that you get better outcomes from the technology that you have. Yeah.
And Ken, you're nodding there. Would you like to add some comments?
I agree with absolutely all of that. I was just going to add a point around, again, the theme of, are we doing too much KYC, and how can technology help, is around, there's a buzzword, and I get the two of these mixed up, continuous or continual KYC. I think that having strong links into the company's house databases of the world to trigger trigger events so we can see that something's happened on a client. So we don't have to wait for 3 years if it's a medium risk client to realize that their shareholders have all completely changed. And that's an area where technology can help, because those databases are out there, and building APIs or whatever it is to do that. I think, again, because in that case, we're actually not doing enough KYC because we don't know the shareholders have changed unless they happen to tell us, and often they might not. So I think that's another area where we can use technology to impact on at least the timing of our KYC, not waiting for 3 years to do a periodic review, but also potentially the volume of it. And I think that's, again, an area worth exploring.
Sam, do you want to talk maybe a little bit around some of the examples of where technology has helped?
Yeah, I mean, I think, again, just bringing in different data sources and different data feeds that aren't necessarily traditional ones. For kind of the higher level, looking at, like I said, social media, things like domain registries. I mean, we've had cases where we've found people existing under different names. And so the name that they've given and that has actually been cleared through all the kind of traditional checks has not been the name that they've had in the past. We had one case where the guy came into the UK and basically started using his mother's maiden name. So he had documents in this, so passed all the traditional checks. But actually, if you looked back through the kind of history of his online footprint and through the open source intelligence, then you found that he previously had a different name, and in the US he was convicted of fraud under that name. But that didn't get picked up in any of the kind of more traditional checks because the name was different. So you put in a different name and you get back no hits, and then he's clear, he's free to go. And I think, like I mentioned earlier, another one is kind of political exposure and kind of sanctions evasion. So bringing in those different networks where you've got someone that you're doing business with who is maybe involved in a network that you aren't quite aware of, but bringing in different data feeds and from other places on the internet is showing you that actually this person is a bit more of a risk based on the people and the companies that they're kind of associating with. And kind of similar is, I think, in sort of COVID times, when we saw the COVID loans getting handed out, we saw a kind of bump in fraudulent applications, I guess, by companies kind of inflating their balance sheets in order to get more significant loans. Again, looking at the networks, looking at the social networks there, could kind of start to show, and like you mentioned it earlier, combining them with the transactional data that's kind of fed in from a different source. If you can bring that all into one place and overlay it, then you can start to see that actually these two companies that have been sort of trading with each other a lot, they're actually kind of cousins or something like that, where they've basically just been sending money back and forth to inflate their balance sheets to kind of then make the most of those COVID loans that became available.
Great. Yeah, I mean, interesting examples, and I think, you know, we have a library of case studies of where the sort of the open source intelligence pieces sort of helped sort of uncover things that the traditional checks wouldn't have basically done. But as we said, you know, it's about sort of trying to get the balance right between sort of that simplified due diligence and making sure that your risk-based approach is sort of correctly set up. I guess going back to our original theme of, you know, sort of, are we doing sort of too much CDD? As we've seen, you know, it's all about sort of ensuring that our risk-based approach is properly implemented and doing the right level. So as we sort of future gaze, you know, look into the future, you know, I guess we come into the last sort of few minutes of the webinar here, you know, and if we can accept that, you know, budgets, you know, can't keep increasing, but the criminals are increasing their sophistication. You know, and our customers are demanding, you know, sort of, well, I guess how do the AML control works need to change to sort of reflect this, and what are the key changes, the key challenges and priorities, and what might the successful sort of financial crime control work look like in sort of 3 to 5 years time? I don't know, maybe back to you, Ken, to sort of look at starting off around sort of that future gazing.
Thanks, Ian. I think a stronger emphasis on what is genuinely high risk. Where, again, we talked about limited resources. Every every financial institution I go to is under pressure to get the costs of compliance down. And I think, again, making sure that you're focusing on the highest risks, especially, and making sure your transaction monitoring and your screening are fit for purpose, and you're not wasting time, back to false positives. I think that's where, because most AML situations would generally be spotted by good transaction monitoring and what the customer is doing versus what you thought they were going to do and what you thought was acceptable for them to do. So I think the future is really about making sure there's a strong focus on the highest risk stuff. And this is absent sanctions, of course, which takes it another realm, but a strong focus on screening and transaction monitoring to make sure you know what your customers are actually doing versus what you thought they were doing, and whether what they're doing is wrong by comparison to what you thought they were doing. So that's what the future looks like to me. Less box ticking, and a lot more risk thinking and transaction monitoring and screening.
Great, thanks. And Christine, from your perspective?
I think obviously just adding to what Ken said, it's mainly to just be aware of the requirement under MLRO, which is Regulation 30A, that requires us to report any discrepancies. This might be something that probably in the future we see any of the technology actually helping us and assisting us to identify that. I'm seeing tools also changing in terms of assisting us to understand complex structures. We're moving away from the old system of having to request for group structures and being able to start working through them. Actually, now any good technology is able to assist you to understand the complex structures that you have. But I think it would be very key for us to have technology that is able to identify any changes and actually create alerts for us, especially for second line, to be able to go back and reflect on the policy that you've implemented, and to also go back and review the customer there and then, rather than wait for any periodic review that you have to do. Yeah.
And I guess over to you, Brian, in terms of what you see.
So again, I think a similar point. I definitely see more attention to tools and technology, and really, in some cases, firms will be using, good and up-to-date technology, but perhaps they haven't, revisited the calibration recently. So, so at the moment, I wouldn't be surprised if most firms kind of look at it, much less frequently than perhaps they should. For me, annually would be, more sensible, because you will be launching products, things will be changing. You'll have different staff, you'll have a better understanding of your data that allows you to do things. It's not that long ago, one of the largest banks in the UK was fined by the FCA for challenges with their transaction monitoring, because they were treating a payment type as a different payment type, and that had a different risk profile. A few weeks ago, Ofsted criticised publicly another bank for the way they acted when they had a sanction match where they only restricted some things but not others. So maybe that's not about the identification of a problem, but it was about but you had the option to block it and you didn't block it, for example. So that calibration runs all the way through to, are you feeding all your records in timely? Are you using the right data points to segment it properly? And then are you doing what you should when you get, the thing that you're looking for? The reason you're doing it is this. So that's one. I think just the other one I'd probably say is, talking about the resource profile. I personally don't see a reduction in cost happening. There's an opportunity to change the profile. I can absolutely see, less people doing things that technology can do, for the simple reason that they can do it faster, more accurately, to more detail. And guess what? They work 24/7 without holiday. So it's a big win. But that to then allow some, people to then move more into that line 1.5 that we spoke about earlier, or even to move across and become more data scientists to help with that regular calibration of tools, because I think that's a big gap in the industry today, where we have data scientists that work with data. We don't have that many financial crime data scientists, and whilst some would argue it's the same thing, again, without knowing why you're doing it, I think there's a need. It's like having a programmer, you know, system programmer that doesn't understand what they're actually trying to program. It's not just about the code.
Yeah.
And in 3 to 5 years, the Companies House changes might have happened because the Economic Crime and Transparency Bill might have passed. So you never know.
We were not going to touch Companies House with its mess. You know, that's why we need the tools to sort of assist us
course.
in gathering this information, because obviously we all know that Companies House is such a mess, and
Today,
you can't really rely on it. But I thought I'll just sort of not cover that and touch it. But you know, I think it's good to just be aware of it. Hopefully in 3 years, as we see things evolving, that also Companies House will also evolve to assist us in that way with the new regulations that are coming in.
hopefully, and
And-
again, they'll be empowered to do that. I mean, that's the thing, isn't it? They'll be empowered to actually do things. But guess what? They've got, you know, 10 million records to clean up, you know, or you know, which again is not their fault that they've arrived in this position, but that's a lot of work. That's the biggest remediation project in the country. So, yeah.
I think Donald
And-
Duck and Jesus Christ will be the first to go. They're both in there.
And Sam, look, we've literally just got a minute left or so. What's on the technology roadmap? What's you know, as a technology company, what sort of things are you looking to build?
Yeah, I think like Ken said, removal of false positives by improving the triangulation that you've got, improving the kind of technological understanding of articles and of databases, so that the humans don't have to spend so much time kind of looking through and trying to make those connections and understandings. I think that's one massive thing. I think automating repetitive processes, so like Brian said, kind of allowing the line 1 to be line 1.5 by cutting out or getting technology to do a lot of the things that they're currently doing that are automated, sort of that are repetitive processes, then kind of allows you to upskill those people, and they can start focusing, like Brian said, on the things that are more relevant, more focused on risk, more focused on kind of the future and monitoring as well.
Thanks for that. Well, look, I'm going to wrap up here. I think it's important we sort of keep to the schedule and keep it at 12 o'clock. So, you know, I'd just like to thank the panel for their insights. I think it's been very informative. I think, you know, obviously there's a lot of work to do. And I'll just leave you with one last comment, which I was at a risk conference last week, and somebody said to us that they were trying to push their boss for a budget increase so they can spend more on financial crime. And the boss basically said no. But the conversation back was, if you think the cost of compliance is expensive, look at the cost of non-compliance. So maybe we'll just leave it there. So thanks everybody for listening, and we will basically put a recording of this up on the internet for people to see. So thanks very much, everyone. Bye now.
Thank you.
Thank you. Bye now.
Thank you.
Bye. Bye.